about, people are still holding on to their jobs, aren't they? We're not seeing, the unemployment rate tick up in any dramatic way. What's happening there?
Well, there's a bunch of things happening. We've still got a fairly tight labour market. Businesses still complain about labour shortages, although those pressures are easing. And you can see that in the vacancy numbers. They've been falling for 5 quarters in a row. But you're right. The strength in the labour market has protected people to some degree. Yes, they've got to pay more to service their mortgage, but as long as they still have a job, that's fine. But history also tells us that there's a lagged impact there, that if you go back to the late 1980s, when interest rates were increased dramatically between 1988 and 1989, the jobs market continued to improve right through that period. It was only in 1990 that it started to fall apart. So the impact of higher interest rates often occurs with a long lag, and I think it will be the same this time around. That as we go through to the end of this year and into next year, we are going to see higher unemployment. The other thing to note is that we need to generate something like 30,000, 35,000 jobs a month, because we've got these record population growth numbers coming through, mainly on the back of higher immigration levels. And therefore, you can still have jobs growth, but I suspect that jobs growth will slow below that critical level. And consequently, unemployment will rise simply because you've just got more people competing for jobs as population growth remains so strong. So that's going to act as a bit of a drag. But so far, we haven't seen that. You're right. But I think as we go through into next year, we will see higher unemployment, and that will start to cause more pain.
OK, that said, given everything you've just said in the last couple of moments, it seems that it's certainly not a fait accompli that the RBA will even raise rates in November. That would be a pretty line ball call still, wouldn't it?
Look, it is a line ball call. There was a recent survey I saw on the weekend, or yesterday, in fact, in the Financial Review, which seemed out of 42 economists, I think half expected no change for the rest of this year, and half expected a rate hike or two. The consensus of that group was one hike, but there was a couple in there with 2 further hikes. So it's a bit line ball, as you say. But I think the risk is a little bit less than that. I wouldn't say 50% chance of another hike. I'd say 40% chance of another hike. And from my perspective, that risk of recession that I've been worried about for the last several months now, if you go back to May, I thought the risk of recession had gone up to 50%. That risk is still there, still very high. It takes a while for these things to fully show up. And the difference now compared to 6 months ago, 12 months ago, is that monetary policy is already very, very tight. So Michelle Bullock takes over at a time when all the heavy lifting has been done by Philip Lowe. We're not talking about easy monetary policy anymore. We're talking about very tight monetary policy. And that's continuing to bear down. So on the one hand, you can say, well, there are these signs of strengthening wages growth in enterprise bargaining agreements and elsewhere. That could be a case for another hike, which we put the risk at 40%. By the same token, we also know that monetary policy is very tight, and there's increasing signs that is really starting to slow the economy down.
Shane Oliver, always good to see you. Thanks so much.